the consumer is very, very stretched to the point of breaking. But while tariffs themselves may not spur long-lasting inflation, empirical studies suggest they trigger an immediate, one-time upward shift in price levels that persists. So actually, I think they're contradicting themselves because they're saying that it's not going to spur long-lasting inflation, and yet prices that go up and stay up, okay. So they just don't want you to realize the truth of it. While tariffs create tariff revenue and favor domestic producers, for a minute, the price consumers must pay to buy imported goods will increase because firms typically pass some portion of the tariffs cost onto the consumers, or maybe even all of those tariff costs. Because we are a globalized system, the supply chains are all over the world. So even if we are a U.S. company, that means that chances are pretty good that something is going to be imported that's going to be impacted by the tariffs. So there's direct tariffs, and then there's indirect costs that they pass on to the consumers. And that means higher inflation. Now, you guys know I've been talking about the fact that I think we'll see much higher inflation to come about by June. It might happen sooner, it might happen later. I don't know. But either way, of course, there's going to be more inflation. There has to be. The U.S. consumer borrowing surges by $40.8 billion, the most on record. But let me show you what these credit cards loans owned and securitized. So what people are doing in order to maintain their standard of living, they're borrowing more money to do that. There comes a point where they won't be able to do that anymore. Job cuts at those same levels. Does this look great to you? Fed wanted to fight inflation? Well, jobs is deflationary, but it is the knock-on effect. It's like a domino. You lose the job over here, but these jobs were also being supported by all these private corporations, and that's getting lost as well. And I'm hoping you're able to see what's really happening, because the February job cuts alone, now understand there was a lot of Doge cuts in here, were 103.2% year over year. That's pretty huge. And the planned cuts last month were the most for a February since, look at that date, 2009. What was happening then? The great financial crisis. So they don't want you to think that that's where we are. But that's where we are. I'm showing you this. How will these job cuts impact consumer spending? Because what happens to all that discretionary income that they might have had when they had a job? That all goes away. Now, I looked at what the Federal Reserve of Atlanta does their GDP now. GDP is gross domestic product. It's all the money that flows through the system. And while it's not an official forecast, it is viewed as a running estimate of real GDP growth based on available economic data. Let's take a look at this. Oh my goodness. Does that look good to you? Because that is a tremendous, tremendous drop in gross domestic product, which has an impact on taxes, and therefore it impacts the state's services as well as the federal government's income, which foretells greater deficit spending both at the state level and the federal level, let alone at the individual level. So even though we're being told that this pain will be short-lived, I don't think so. What do you think? Do you think this is going to be short-lived? Because who's going to absorb all of those people that lost their jobs? U.S. gold stockpiles hit record, right? And they're always pointing to the tariffs, but maybe what we're really looking at is a repatriation, because in this country, in the U.S., most of the gold is done in derivative form. That means it's just paper gold. It's not real. And you can look at the gold inventory in the COMEX warehouse, and they hit a record high. But could you please take a look at when this happened and it never got back to those other levels, and now it's even higher? because the dangers are even more. So you have to ask the question, who is getting ready for what? Because there is some fat finger or big player here in the US that is demanding physical delivery. And of course we know, because we've talked about this, that a lot of that physical gold is coming from the Bank of England, among other places, but a player in the physical gold market. They're holding gold for a whole bunch of governments, and they're shipping that gold to the US, and then that gold is being delivered out to a private party. So I think that what we've got coming in the future is a massive government global pulling back of the gold. So my question is this really just about the tariffs on gold, or could this really be so much bigger than that, and it's a repatriation of the physical gold market? Time's going to tell what it is. We're going to keep paying attention to it, but I mean, I think it should be pretty darn clear that there are things that are falling apart, and if we're dependent upon the consumer is one big one. What are you going to do when this whole system implodes? Because that's what's happening, and it will. And that's why you have to have physical gold and physical silver in your possession. And you need to have sound money as a foundation for whatever else you're attempting to do. Because a properly diversified portfolio, okay, it can have some intangibles, it can have some cryptocurrencies, some stocks, some bonds, some mutual funds, some ETFs, but you darn well better have the gold to balance that out. So that when the dollar goes to zero, and you might not even believe that it's going to zero, look at the purchasing power chart, because the Federal Reserve is telling you that it's going to zero, and it's very close to that now. It's just that little layer of confidence. And if we're having to deal with higher inflation, what do you think that's going to do to the public's confidence in the currency and in those that are driving the economy? That's it. It's the last layer of confidence, and I see it going away.